Portfolio planning and construction examines the process of designing investment portfolios that align with investor objectives, constraints, and risk tolerance within the program. Portfolio planning involves identifying the financial goals, liquidity needs, tax considerations, legal restrictions, and investment horizon of an investor before selecting appropriate investments. Effective portfolio construction combines quantitative analysis with professional judgment to create diversified portfolios capable of meeting long-term financial objectives. Investment professionals must balance expected return against acceptable levels of risk while ensuring the portfolio remains consistent with the client's circumstances. The topic demonstrates that successful investing requires disciplined planning, structured asset allocation, diversification, and continuous portfolio monitoring rather than isolated security selection decisions alone. A central component of portfolio planning is the Investment Policy Statement, IPS. The IPS is a formal written document that outlines the investor's objectives, constraints, and guidelines governing portfolio management decisions. It typically includes return requirements, risk tolerance, liquidity needs, time horizon, tax considerations, legal restrictions, and unique preferences. The IPS serves as the foundation for all subsequent portfolio decisions and provides a benchmark against which portfolio performance can be evaluated. A well-constructed IPS helps maintain investment discipline during periods of market volatility and changing economic conditions. It also improves communication between investors and portfolio managers by clearly defining expectations, responsibilities, and acceptable investment strategies. Risk tolerance is one of the most important factors influencing portfolio construction. Investors differ in both their willingness and ability to accept risk. Younger investors with long investment horizons and stable income may tolerate greater portfolio volatility because they have more time to recover from market declines. Retirees or investors with immediate liquidity needs generally require more conservative allocations emphasizing capital preservation and stable income. Risk tolerance affects decisions regarding exposure to equities, fixed income securities, cash, and alternative investments. Portfolio managers must carefully assess both psychological and financial aspects of risk tolerance to ensure portfolios remain suitable and aligned with investor objectives throughout varying market conditions. Asset allocation is another critical element of portfolio construction. Strategic asset allocation determines how portfolio capital is distributed among major asset classes such as equities, fixed income, cash equivalents, and alternative investments. Research consistently shows that asset allocation decisions are primary drivers of long-term portfolio performance and risk exposure. Equities generally offer higher expected returns but greater volatility, while bonds provide lower risk and more stable income. Alternative investments may enhance diversification and inflation protection. Effective asset allocation seeks to optimize the balance between expected return and risk according to the investor's objectives and constraints. Diversification across asset classes also reduces exposure to individual market or economic shocks. Diversification is fundamental to modern portfolio construction because it reduces portfolio risk without necessarily lowering expected returns. Combining investments with imperfect correlations allows gains in some assets to offset losses in others during changing market conditions. Diversification can occur across asset classes, industries, geographic regions, investment styles, and securities. By reducing unsystematic risk, diversification improves portfolio efficiency and stability over time. However, diversification cannot eliminate systematic market risk caused by broad economic factors such as recessions, inflation, or interest rate changes. During severe market crises, correlations among asset classes may increase temporarily, reducing diversification benefits. Nevertheless, diversification remains one of the most effective and widely used portfolio risk management techniques. The topic also discusses active and passive portfolio management approaches. Active management attempts to outperform market benchmarks through security selection, market timing, economic forecasting, or tactical asset allocation. Active managers seek to generate alpha by exploiting perceived market inefficiencies. Passive management, in contrast, aims to replicate benchmark performance rather than exceed it. Passive strategies often involve index funds or exchange-traded funds with lower management fees and turnover. Each approach has advantages and disadvantages depending on investor objectives, market efficiency, cost sensitivity, and confidence in manager skill. Many institutional portfolios combine active and passive strategies to balance cost efficiency with opportunities for excess return generation. Portfolio construction also requires periodic monitoring and rebalancing. Over time, market movements may cause portfolio allocations to drift away from target levels established in the IPS. Rebalancing restores desired asset allocation weights and risk exposures by buying underweight assets and reducing overweight positions. This process helps maintain portfolio discipline and prevents unintended risk concentrations. Portfolio managers also monitor changes in economic conditions, tax laws, interest rates, inflation expectations, and client circumstances that may necessitate strategic adjustments. Performance evaluation compares portfolio returns against benchmarks and objectives to assess whether the investment strategy remains effective and consistent with the investor's long-term financial goals. Overall, topic demonstrates that portfolio planning and construction are systematic processes requiring careful assessment of investor objectives, constraints, risk tolerance, and market opportunities. Investment policy statements, asset allocation, diversification, and rebalancing form the core framework for building efficient portfolios aligned with long-term financial goals. Successful portfolio management integrates both quantitative analysis and disciplined judgment to balance return expectations against acceptable levels of risk. The topic reinforces that no single investment strategy is appropriate for all investors.